Today's housing market, should you buy right now or wait for the crash? Let's go over the exact math. For this example, we're using a home price of $300,000. That's in 2020. We're using a 30-year fixed rate at 3.8%. So that gives a down payment of $60,000, 20% down. Total monthly payments would equal $504,000 for a total out-of-pocket of $564,000 in 2050. For this first scenario, we're going to use 3% inflation, and we're going to assume that the home price goes up with the rate of inflation, which would be 3% as well. If that's the case, at the end of the 30 years, the home price would be $728,000. So we deduct the home price of $728,000 by the total out-of-pocket, which gives us a plus $164,000. Now, before you get really excited about that, we got to remember that the goods and services that this home would have bought in 2020 is the exact same as the amount of goods and services that this home would purchase in the year 2050, although the price went up. So you can't use this number, that's not going to be exact, but you also can't use this number because you're paying back the loan with gradually cheaper dollars. It gets really complex here. You've got two cross currents going on here. You've got one that's actually benefiting the homeowner and one that's hurting the homeowner. To make this a little less confusing, let's go ahead and look at it this way. If you were to buy that home in 2050 with $564,000, let's say you just paid cash for it, you definitely would have $164,000. Or if you would have paid $564,000 for that home in 2020, you definitely would have a loss. But the dollars in 2050 wouldn't buy you as much stuff, goods and services, as that $564 would have purchased in 2020. As another example, $100 in 2020 would only purchase $40 worth of goods and services in the year 2050. So without going into great detail here, it's a lot easier if we just split the difference. So the result of this scenario, where you have 3% inflation and the home price goes up with inflation 3% a year, you would lose about $50,000 worth of purchasing power. Going over to the next example. This is a heck of a lot easier because we don't have to deal with inflation. Here we've got 0% inflation and the home price appreciating with that inflation, which is 0%. So our out-of-pocket is going to be $564,000. The home price will still be $300,000, which would give us a negative $264,000. Next, we've got our 2008 scenario where we've got 3% inflation per year, but home prices drop by 50%. In this case, we'd start with $300,000 and we'd end up with the price of the home at $150,000. But remember, those dollars have lost purchasing power over those 30 years by 3% per annum. So the actual purchasing power of this house in the year 2050 would be only $60,000. So we'd have a double negative. But keep in mind, we're paying things back with cheaper dollars as well. So we've got to split the difference between the two. So 150 minus the 564 gives us a minus 414,000. The 60,000 minus the 564 gives us a negative 504,000. We split the difference and we've got a negative 459,000. So if you're having a tough time following this, guys, all you have to do is just follow along with the number that I have circled, and that's the takeaway. That's what you want to focus on. Now we've got our Japan type scenario, and that's where inflation does not go up, stays the same, but prices go down by 50%. Again, this one's a lot easier because we don't have to deal with that inflation. So the price would go from $300,000 down to $150,000. We subtract the 564 that we have out of pocket, we give us a negative 414,000. Moving on, we've got the 1970s scenario. That's 10% inflation, but 5% home appreciation. So if you'll notice in the 70s, they actually lost money. Although the prices of the homes went up in nominal terms, in real terms, they actually went down. In this scenario, and this is inflation on steroids, this is where the numbers really get weird, but bear with me. The price of the home would go from $300,000 to $1.3 million. But the value of the home would go from $300,000 all the way down to $55,000. Really crazy. So if we take the $1.3 million, we subtract the $564, that gives us a plus $736,000. If we take the 55, subtract the 564, that gives us a negative $509,000. But remember, we got to split the difference there because we've got those two cross currents. That gives us a plus $113.5 thousand. We looked at the math for buying in today's housing market. Now let's check out the math for waiting for a 50% crash. Our price, $150,000, down payment $30,000, monthly payment $267, total out of pocket $297. I'm using a 3% or 3.8% interest rate on this as well, and I'll get to why in a moment. With these numbers, our starting price is $150,000. At the end, our price is $364,000. So we've got those two cross currents going on where we haven't gained any purchasing power, but we're paying things back in cheaper dollars. So remember, we're just splitting the difference to get an approximate number. That's going to be a minus $40,000. Going over to 0 and 0, that's really easy, no inflation. We have a minus $147. And again, that's because we're taking the 150, we're subtracting by 297. That gives us minus 147. Our 2008 type scenario, it's pretty much the same number as we have here because we've already absorbed that 50% loss. Same thing with the Japan type scenario. It's the same number that we have here because we have no inflation, but we've already absorbed that 50% loss. Here is where things change dramatically. I actually used a 9% interest rate here. And a lot of the questions that I've had from viewers say, well, George, let's compare the 150 at 9% to the 300 at 3.8%. But that's not a real good comparison because I went through and tried to figure out what the probabilities would be for housing prices to drop by 50%, but have interest rates go up as well. And the probability of that is extremely, extremely low. I would put it at almost zero. The only situation where it would be probable that interest rates would go up and prices would go down in real terms would be if you had 1970s type inflation. So that's why I only use the 9% interest rate here as opposed to the entire example. So that said, we've got prices. Our starting price is $150,000. Our end price was $648,000. But remember, we're paying a much higher interest rate. So our out-of-pocket cost has gone from $297,000 to $443,000. That would give us a plus $205. But we've lost a tremendous amount of purchasing power because we've got a difference between 10% and 5%. So our purchasing power of that home would go all the way down to $27,000. So again, we split the difference and that gives us a negative $105.5 thousand. Now let's go ahead and compare the two examples, the moment you've all been waiting for. We've got the $300,000 example that's buying right now. We've got the $150,000 that's waiting for the crash. Now you can see the difference here, but I didn't add these two up. Why didn't I add them up? I didn't because the probability is so low for this actually occurring. Let's go back to that chart that I always use, going back to 1900 adjusted for inflation. And we've got our peak in 2006. This is where we are right now. And this is our historic trend line going all the way back to 1900. In order for one of these scenarios to be true, our trend line going out another 30 years would have to go from here all the way up to here. This would have to be our brand new trend line. And if you think about what would have to happen from a macroeconomic standpoint in order for us to maintain this delta, the odds are incredibly low. You may be asking yourself, George, why didn't you go over a scenario where the rate of appreciation would exceed the rate of inflation? The reason I didn't do that, because like I said, even keeping things consistent with this trend line and this delta between this trend line and our historic trend line, the probability is extremely low. So if the probability of this is low, how low is the probability of prices actually going up higher and this delta increasing in size? It's almost zero, so I didn't even do that math. But remember, you guys have all of the numbers that I used. So feel free to take those numbers and rework the math on your own. So I want to focus on what I think is more probable. That's the 2008 scenario, the Japan scenario, or the 1970s scenario. So in our 2008 scenario, you would lose $419,000 by purchasing now. Japan, you would lose $267,000 by purchasing now. In 1970s, you would gain $219,000 by purchasing now. So then the next question becomes, what are the probabilities of each event happening? That's where we really get into the weeds, and I'm not going to go that far on this video. But let's say that each event has an equal chance of occurring. So 33%, 33%, and 33%. The decision that you would have to make is, are you willing to take a 67% chance of losing at a minimum $267,000 to take a 33% chance of gaining $219,000? I know what my decision would be. That's a terrible investment. Those are bad odds in my opinion, but I can't make that decision for you. So what's the grand takeaway from all this math? Pretty obvious. Don't buy a house. Ever. In every single scenario, you're almost guaranteed to lose money. So what that means is you either house hack or you rent where you live and own what you rent. And for all the information on how to do that, check out this content right here, and I will see you on the next video.